Hello, welcome to our next set of notes. We're on our last set for Unit 1. Today we get to cover taxes. We're going to talk about how taxes work, kind of give a run through, going through and just talking about the different steps of the process of calculating your taxes, figuring out what your taxes would be. The actual tax code is actually thousands of pages long and changes every year. It get kind of complicated. There's a reason why there's lots of tax experts, people that study taxes. But most people in most situations can actually file their own taxes and understand them pretty well enough to actually make good decisions about their finances. Most people don't have a lot of complex things going on in their taxes. You know, there are exceptions. People that start running small businesses, people that are connected to farming, people that have special circumstances, maybe a disability, something like that, their taxes get more complicated. But most of us that just work for a paycheck at the end of the month, through an employer, have pretty simple taxes. So we're going to talk about the process. At the end of this, I don't expect anybody to just run out there and be a tax expert, but have at least a good enough understanding that you probably know what a tax expert's talking about when they talk to you about some of these things, and you can kind of look and see what to expect for your taxes, as long as you're not in one of the more complicated situations. So first off, when you first start doing taxes, first thing you figure out is your gross income. Gross income is all the money you haven't come in, whether it's wages, it could be tips, profits from a small business, interest or dividends from investments. So it's money coming in. That's what you're going to be your gross income. So wages, tips, profits, interest, dividends, any other income. Money have you coming in, that's your gross income. Now, you don't usually get taxed on your total gross income because you can make what are called tax-deferred or tax-sheltered savings. So the first thing we do after you find your gross income is you adjust that by subtracting. Take your gross income and you subtract portions that are not taxed, and that gives you your adjusted gross income. So adjusted gross income is your gross income minus, these non-tax portions. Tax-deferred savings, this is usually where you're saving up for retirement, stuff like that, and that's the first thing we take away. Then after that, you'll actually take away deductions. So we have a deduction. We'll talk more about what deductions are. But you subtract that from your adjusted gross income before you calculate taxes. So that's what the deductions are. So we're going to do one more subtraction. Then you have what's called the taxable income. Taxable income is the money you have left after you subtract the deductions from your adjusted gross income. And it's the amount you'll use to do the actual tax calculations. So it's the amount left after subtracting deductions from adjusted gross income. After you've done your tax calculations, those are more complicated, we'll get to that page and we'll talk about those, but after you've done your tax calculations, figure out how much you're going to pay in taxes, then you would subtract your tax credits. So tax credits you subtract from the amount of tax you owe, and these are determined by, the amount of tax you owe is determined by your taxable income. These are determined by different situations. We'll talk about what can cause a credit, but tax credits are usually a good thing because they usually save you a lot of money in taxes. So tax credits, you subtract that, and then you pay less taxes. Once you've subtracted your credits, you have what's called your total tax, and this is how much you actually have to pay the government. So the amount of taxes you owe after you subtract those credits. But most of us throughout the year, we actually pay our taxes ahead of time. We pay them each month when a little bit of our paycheck goes to the government each month. That prepayment is typical. Basically what we do is we pay every month, and then at the end of the year, when it's time for taxes, we say we've probably paid a little bit too much, so we calculate our taxes and we get a refund typically. So you get a tax refund. It's payment from the government to refund money that's above your total tax amount. So you already paid too much. The reason we do that, the reason why this is kind of how our system works, is one, it makes it easier for the government to collect taxes because you pay them every month. But for you, what happens is if you don't pay enough taxes, if you don't pay a little bit over, or don't pay the amount, you pay too little, then you can end up with penalties because the government actually will charge you fees for your penalties for saying you didn't put away enough money to pay for your taxes, and that's to help them avoid the situation where someone just doesn't have enough money to pay the taxes at the end of the year. So that's part of the requirement, is that you need to put enough money away. You need to pay the government enough throughout the year. And that's why most people end up getting a refund. It is possible you might not get a refund. If you're close enough, it's not a big deal. You might have to pay some in, but you won't get charged penalties. Or even possibly pay just the right amount. But usually most people have a little bit of a refund. Just depends on your situation. So the process is you start off with gross income. So we have that starting amount, gross income. We subtract the adjustments. These are tax deferred savings, and that gives us our adjusted gross income. We take that adjusted gross income and we subtract deductions, which we'll talk more about deductions later, get your taxable income. Then you have to do some calculations. So we're going to use the table to get to our computation rates based on these tables. Then we can subtract tax credits to get our total tax. So how much tax you owe. And then the last thing is you take that total tax and you subtract your payments that you've already made, the withholdings from your checks, and that'll give you typically your refund. That's usually what we have at the end there. So that's the process. A lot of subtracting right here, going from the taxable income to the tax, how much you owe. That's kind of a big calculation we'll get to there later too. But it's important to understand this process, each one of these steps, and to know that you have to remember to take gross, subtract to get adjusted gross minus deductions to get taxable income, calculations minus tax credits, total tax, and then subtract your payments that you've already paid in to get your refund. So first off, like we said, adjusted gross income. The government actually encourages people to save money for things like retirement, and, medical care, college studies, by giving you options where you can put pre-tax money away into these accounts. So it's money you didn't have to pay taxes on, and you get to invest it, and then it grows with interest. You're using that compound interest you've been learning about. And then you have a lot more money when you go to retire or pay for school or pay medical bills because you're using pre-tax money. It also lowers your tax rating, which is great for you. So it's really a big benefit. Some of these accounts will be like IRAs, some HSAs, stuff like that. There's different types of accounts where you can save with pre-tax money. Now, these savings, these investments, you take that from your gross income, you subtract that, and you get your adjusted gross income. So anytime we talk about like tax deferred, pre-tax, that kind of thing, it's money where you're going to not include it in your adjusted gross. It's included in your gross income. It is part of what you earned. You subtract it before you calculate your adjusted gross. So to calculate these values, we're actually going to do this on an example here. We're going to find someone's gross income, their adjusted gross income, and their taxable income. First off, we have to look at what they're making. So their wages, in this case, Jeff earned $45,000. He received $5,000 in interest, and that's all everything has coming in. And then it says he's paid $3,500 to a tax-deferred retirement account. So that's out of the money he had coming in. He put some of that in a retirement plan. He takes the standard deduction of $12,500. We'll talk more about deductions. There's different options for deductions. He just took the nice simple standard deduction, and it'd be about $12,550 for him. So we want to find his gross income, adjusted gross income, and his taxable income. Now, first off, gross income is pretty straightforward. You just look at what he has coming in, and that's total. So you have $45,000 in wages, that's money he has coming in, and he had $500 in interest from his savings account, so that's money coming in. So that is his gross income. Things like the $3,500 to tax deferred, that doesn't count because that's money he's taken out of his income to put in a savings account. So it's not part of his money coming in. So this is all he has coming in. So he ends up with $45,500. That is his gross income. This is money coming in. So AGI, adjusted gross income, we take that gross, that $45,500, but now we subtract any pre-tax savings. So anything that's not going to get taxed because he put it in a special pre-tax savings account. In this case, that would be the $3,500 because it's tax deferred, means we don't pay taxes on it right now. He will have to pay taxes on it in retirement, but he gets the benefit of not having to pay taxes on it right now. So $3,500 that he earned, but he's not going to pay taxes on it because the government wants us to be able to save for retirement. So that's $42,000. Now that he is actually going to count as like income when he starts calculating his taxes. Now we don't get taxed on that full amount because first we get to subtract our deductions. So to find the taxable, now this is the money that's actually going to be taxed. To find his taxable, he's going to take that AGI, that adjusted gross income, at $42,000, and he's going to subtract. In this case, he had $12,550 in standard deduction. So he's going to subtract that standard deduction from his AGI, and that will give us his, taxable income. So what you got? 42,000 minus 12,000 would give us 30, but minus another 550, so it's 29,450. So he has 29,450, and this is in taxable income. So now when it comes to calculating his taxes, the government doesn't use his gross or his adjusted gross, they use his taxable. This is what's used for calculating the taxes. And so when we get to the tables and charts and how to calculate the taxes, calculate in taxes, we're going to use the taxable income. And that's why we have this process. Instead of charging him taxes from his full $45,000, we actually only get to look at $29,400 and then calculate taxes. The idea being that if you're on the lower end of the pay scale, if you're not making a lot of money, this little process at the beginning where you get to take away some, not count pre-tax, savings, not count, you get to remove that deduction, really will help you get you at a better spot where you're not going to pay as much taxes, versus if you have a really high, amount of pay, then you're still going to pay a decent amount of taxes, and that's how that kind of works. Is having that little chunk, that standard deduction, the exemptions for the retirement savings, it just lowers the tax burden on the lower end. Let's try one more example. This is Beth. Beth has a small business, and it's doing pretty well. She's making $75,000 in profits. So after expenses, she has $75,000 in profits. She also had $2,000 in stock dividends, so she earned that from dividends from stocks. So this is all money she has coming in. So her gross, again, it's going to include these things that are coming in. This is money she's making. She's making $75,000 plus $2,000 in the stocks. So she's making $77,000. That's her income coming in. Next, to find her AGI, her adjusted gross income, we have to take this gross income she has, and we have to subtract her stuff that's tax exempt, the stuff that she's not paying tax on because it's pre-tax savings. In this case, she has $4,000 in some kind of pre-tax health savings account. She has some kind of health savings account where she gets to invest money that's not being taxed. So that is being subtracted because it's not included in her tax amount. So here she ends up with $73,000 now after taking away that health savings account. So that's not going to be qualified as part of the money she's going to be taxed on. Finally, to find the taxable income, so how much she's actually going to be taxed on, we take that AGI, $73,000, and we subtract her deductions. In this case, instead of taking the standardized deductions, she has itemized deductions. We'll talk about the difference between those two more later. But her deductions for this case are $15,400. So you have kind of choices on which deduction, but she chose this one, itemized deduction, saved her $15,400. So we'll subtract that from her $73,000. I don't feel like doing it in my head, so I'm just going to use my calculator. $73,000 minus that $15,400, and she ends up $57,600. So $57,600 is her taxable income. So she's doing a little bit, higher wage than Jeff is. She's making more money. So she's going to pay more taxes when we do the tax calculations because her taxable income is at a higher amount. So when we do the percentage of her taxes she's going to pay because she's at a higher level, we'll take that percentage into account. So that's the idea. You need to figure out your taxable income before you can actually figure out what your taxes are. Now, we mentioned deductions. We should talk a little bit more about what deductions are. So deductions vary. There's actually lots of different types of deductions. They include the standard deduction, so pretty typical, or itemized deductions. And you don't really get to do both. You kind of do one or the other. Itemized deductions can include things like mortgage interest. So when you have a house loan and you're paying interest on the house, to pay back that loan, that mortgage interest is deductible. Charitable donations. So if you give to the 501(c) corporations that are government recognized charitable organizations, you get money off of those. If you have state taxes, we don't have state income tax in South Dakota, but we have other things like property taxes. Have tax on sale of something. Other states do have state tax, income taxes, and so that will change. They'll have to pay those, and then those would come away from their income tax. So those are the itemized type of deductions, and there's more. Those are just a couple examples. Now, you get to choose. You can either take the standard deduction, it's just a set amount, and that's what you get, or you can itemize. You can do one or the other, but not both. There are some itemized deductions that could still be claimed when you have to take the standard deduction. They're not very common. They're kind of a weird, rare case, so something to think about. Sometimes you might want to take the standard deduction and still claim some itemized, but most of the time you either get the itemized or the standard. That's typical. Standard deduction, again, is a set amount, It actually depends on your filing status, so we'll talk about filing status here in a minute. So the standard deduction, you just say this is the amount I get to do. Itemized deductions, again, you add up all your individual deductions, and that's your itemized deduction. Everything that you should get besides the standard. Don't include the standard because the standard is not part of the itemized deductions. So for example, decide whether you should itemize or take the standard deduction in the following case. Your deductible expenditures are $9,500 for interest on home mortgage, so you're paying interest, so you have deduction for that. $1,500 for contributions to charity, $750 for state income taxes. Your filing status entitles you to a standard deduction of $12,550. So that's like the single filing status when I was doing these notes. So that would be the standard deduction. Now, to get your itemized, you're going to add up all the different things that count. So the $9,500, because you get that from having paid interest on the mortgage, the $1,500, because you made contributions to some charity, and the $750 for state income taxes. Those things would all count as itemized deductions, so you get to add those up. So you get 5, 10, 17, 1. So I think it's about $11,750. And this would be your itemized deduction. So one of your options would be to claim the itemized deduction of $11,750. Again, this does not include the standard deduction because that's not part of your itemized. Your choice is either itemized or standard. In this case, the standard deduction is $12,550 for this person. And it does vary from person to person, but this person, this is their standard deduction. They have to choose, do they want to take $11,750 or $12,550? Now, every once in a while I get someone saying, oh, I want less taxes. I picked the $11,750. Well, that shows a confusion about that first page we talked about. Remember, the whole point of deductions is you take a deduction, you subtract it from your AGI to get your taxable income. The more you subtract, the lower your taxable income, the less taxes you pay. So with deductions, you always want to choose the larger, because you want more deductions to reduce your taxes. So you're going to subtract this and to make your taxes smaller. Choose larger value. Now, it's optional. If you just are really lazy with your taxes and you don't want to figure out your itemized taxes because it's a lot of work and you just want to take the standard, you can, even if it is the worst of the options. You know, the government will totally say, oh yeah, that's fine. You can take the standard, you know, every time you want if you want to. And some people do that. They just say, hey, you know, it's not worth my time and effort to figure out what my itemized deductions are. I'm just going to take the standard. Especially if you've done it for a few years and you almost know that it almost always is the standard deduction you could take, then you might kind of get lazy about that. But if you want to make sure you're getting the best deal, you know, paying the least amount of taxes that you can, you want to figure out your itemized and your standard and then just select the one that's actually bigger. So in this case, standard would be better. And that's what I'd be looking for on the test. I would say, you know, try to be lazy, figure out both, and then pick the larger out of the two. You know, I want to know that you know that when it comes to deductions, the bigger the deduction, the more you save. Now I mentioned filing status. When you file your taxes, you have a filing status, and the different statuses lead to different things like different deductions. So the standard deduction is actually dependent just on what your status is. Now most people fall into one of these big four categories. First off, if you're not married yet, you know, if you're unmarried still, if you were married but you're divorced legally or legally separated, then you'd be single. So before you get married, you're single. A single person just has the basic deduction of $12,550. That's their deduction. Now, if you get married and you file your taxes together, you don't have to file separate. You can just file one joint set of taxes. So that's called filing jointly. That's what my wife and I do. We're married and we file our taxes together jointly. Then we get the married filing jointly status. And then things like our standard deduction is going to be bigger than for someone that's by themselves. But part of that is because we're combining our income, so we get basically two standard deductions, one for each person. That's kind of how that works. So married filing jointly. If you're married, you can also file your taxes separately. So each person, you know, records the income, their separate incomes, and then they have their own separate deductions and all that, and they file their taxes separately. And then they don't get to combine like their standard deductions. Each will have just one standard deduction. Usually, if you have like children, dependents, you have to put that in your taxes. And so if you file separately, you have to decide who's like, you know, picking which children. It gets kind of more complicated, but there are certain situations where filing separately might save you some money in taxes versus filing jointly. It really depends on income levels and stuff like that. I believe jointly is set up for the kind of the traditional, 50s married family of, one spouse is working full time, the other one's working at home or not working. Um, so then, income's kind of slanted to just one side. As the married filing jointly lets them combine their deductions on that one income. Versus if you're filing separately, that's usually, I think, a little bit better for people that are um, both working full-time jobs, making about the same amount of money, and so they might have a situation where doing the deduction separately, they could probably save a little bit. So if you're married, it's something where you can kind of look into that. That's maybe one of those situations where you might consult the tax accountant and say, which one should we do? Should we file it jointly or separately with our situation? They'll look at your finances and kind of tell you which one's going to save you more money. Or you can always prepare them online, use one of the programs and do it either way and see which one's better. Head of household. So if you're unmarried, so you're not a married person, and you are paying more than half the cost of the supporting a dependent child or parent. So this may be you never got married, but you have a kid, or you were married and got divorced, your spouse died, something like that. If you have a child or a parent that you are caring for, you're paying for the costs of caring for them, you're paying for their food and housing and stuff like that. Then you do head of household. Single people are considered to not have kids because they're single. They're not married. They're not connected to someone. A head of household would be someone that actually has kids. And so that's the kind of the difference between single and head of household. Head of household will get a little bit larger deductions and stuff like that because the government expects them to need some more of their money to pay for their child care or elder care. Versus someone single doesn't have those dependents, then they probably don't need as much of their money. They can spend it more on themselves, so they don't get as much of a tax break. So those are the big filing statuses. Which values you use, we'll see on the table here, will depend on which your status is. You get different deductions for the different statuses. Okay, so we talked about taxable income. Taxable income, again, is the amount remaining after you subtract your deductions from your adjusted gross income. And this is what you use to calculate taxes. So let's look at an example. So Alex earned $25,000 as a part-time job. He had $15,000 in tips. He invested $5,000 in a pre-tax college account. He is single, decided to claim the standard deduction of $12,550. What is his taxable income? Again, so we've kind of done this already, but we're doing it one more time. We want to find taxable income before we can calculate taxes. So taxable income, again, first we're going to find the gross. Because you need gross before you get to taxable income. So you had $25,000 plus $15,000 in tips. This is money coming in. Ends up being about $40,000 total he has coming in. Then he wants to find his AGI, because we need that before he can get taxable income. So he has $5,000 invested in pre-tax college savings account. So he's going to subtract from that $40,000. He's going to subtract $5,000. So he has $35,000 for his AGI, and we subtract the pre-tax amount to get the AGI. And then finally, his taxable income, again, his taxable income is that $35,000 minus his deduction. Again, because he picked the standard deduction, it was the better option for him. They actually raised the standard deduction back in 2017. So a lot of families right now are using the standard deduction because it's the better option. It just depends on your situation, but for a lot of people, that's the best option. So he is going to do that as well. He's one of the common, typical group. Subtract the standard deduction. That will give him his taxable income. So we get what, 23, so 22,450, and that would be his taxable income. So what he does now, once you have taxable income, you look at our tax charts and you use these to figure out your taxes. So for Alex's situation, where he has $22,450 and he is single, notice he's single, he would look at the tax tables and he would look at the single table and he would use that to calculate his taxes. Now the U.S. tax has what's called a progressive income tax. That means that people with higher taxable incomes will actually pay a little bit higher tax rate, and it could be significantly more depending on how high you go up the income ladder. Anybody that's making less than, single less than 10,000. I'm just going to single for now because that's what Alex was. If you make less than 10,000, you're only paying 10% on any of the stuff, and this is 10,000 after deductions and things, all that stuff. So if you get down to less than 10,000, then you have 10%. So you could make 20,000, 25,000, but after deductions and stuff, you might only have less than 10,000 in income, and you'll only be taxed at 10%. If you make over the 10,000 up to like 40,000, now some of your money will get taxed at 12%. It doesn't mean all of your money gets taxed at 12% because only the money past the first 10,000 gets taxed at that amount. So if you had like 30,000 in income, the first 10,000 would be 10%, and the next like 20,000 from 10,000 up to 30,000, the next 20,000 of your income would tax at 12%. That's what happens. It jumps up. So after you get past 40% or 40,000, then money gets taxed at 20%, 22%. So anything between 41,000 and 86,000 gets taxed at 22%. And then up there you get to 24%, 32, 37, 35, and then 37. But again, 37% is only taxed on people that are making over 523,000. So if you're not making more than $500,000 per year, you don't see this 37%. And that's after deductions. And a lot of people that make lots of money usually have it for their businesses. So this is already like they already take out their expenses and stuff. So this is just their profits after expenses. Standard deductions are down here. So notice the single person gets a standard deduction of $12,550. Married, filing jointly, they actually get double that. So you just add that $12,550 twice, you get $25,100. Married, filing separately, well, since they both get it because they're filing separately, they both get $12,550. And again, head of household, because they have the dependent care, gets a little bit higher standard deduction. These different levels, different rates are called margins or brackets. So if you ever heard some people talk about being in a higher bracket, it means that they have some income that's being taxed because they've actually made enough money to move up to the higher rate. That's what a higher tax bracket is. One of the big confusions that I think people have, and this really leads to a lot of misunderstandings about taxes, is some people think that because you're in the tax bracket, all of your income is being taxed at 37%. That's not true. Everything you make under 500,000 is taxed at the lower rates. Only the money above 500,000 is being taxed at 37%. So your first $523,000 is taxed at the rates below that. Only stuff above 523,600, only stuff past that is being charged at 37%. So if you make $1 million, you have 500,000 that's being taxed at less than 37%, and then you have 500,000 above that's being taxed at 37%. And because that income is such at a high level, we kind of look at that and say, you're not going to be using those that second $500,000 for basic living expenses. You probably could afford that with the first 500,000. You could pay for your food and lodging and all that kind of stuff, clothing. The other rest of it's basically just going to be play money. There's no one that needs $1 million for their basic necessities. So that second 500,000 we tax at a higher level, assuming that you don't need it to live off of, and we can take that and give it to people that need it or pay for the services that the government provides. Things like roads and schools and stuff like that help support that kind of lifestyle. So that's how our taxes work. We'll take these and we'll figure out the tax amount from taxable income. So let's go ahead and do that on the next page. So we're going to calculate some taxes. So we're going to use this marginal tax rates, and we're going to calculate taxes for this situation. In this case, Orson is single, so it's really important. Again, the tax rates you pay depend on your status. So we know he's single, so we're going to be working in the single column because he's single. So we're not going to look at these other numbers. You'll notice that they're all different. The different levels are different, so you have to pay attention. The married, filing separate is very similar. That's about the same. It is a little different up at the top levels. So there's a little perk there for the single and not married, filing separately, I guess. Okay, so he's single. He has an adjusted gross income of $66,800. Now notice this is not his taxable income yet. Before we can start calculating taxes, we do need to take that find the taxable income. So they didn't tell us that, but they did give us some information because we know the standard deduction. So we're going to just assume he has the standard deduction. I have a little typo because I want to say you took the standard deduction, and I forgot to finish typing that out. There's a little typo. All right, so he's taking the standard deduction. So from his to get his taxable income, we're going to take that 66,800 in gross income, subtract the standard deduction, and that'll tell us how much he actually has for his taxable income. So 66,000, you get 54,000. 800 minus 550 gives me 250. So he has $54,250 in taxable income. Now that we know his taxable income, we can use the chart to figure out how much taxes he's going to pay. He gets all the way through the 9,000. He makes that much money, so we move to the next column. He actually makes more than 40,000, so he makes it to the next column. He does not make more than 86,000, so he's only going to be paying in the first 3 rows. He's not going to be taxed at the rest of them because he doesn't make any money above $80,000. If he had gone above 86,000, in his taxable income, then we'd be paying more. But because he only makes it to 54,000, we only have to use the first 3 rows. So first off, the first row, he maxes this out. He makes more than $10,000, so he's going to pay 10% of everything up to $9,950. So the very first row, we're going to do 10%, so 0.10 times this $9,950. And that's going to tell us how much he's going to pay for the first margin, the first bracket. So multiply that out, I get $995. So for the first $10,000 he makes, he's going to pay about $1,000 in taxes. Now in the next bracket, this is only money that's past the first $9,950 up to $40,525, and at that rate he's going to pay 12%. So we're going to do 12%, so we're going to do 0.12 times this amount of money. Since he maxed out this row, he has more than $40,000 in taxable income. We're going to take the $40,000 for that row, and he's going to pay all of that, but we already paid for the first $9,000. So we can't charge him for that $9,000 again. That would be incorrect. So what we're going to do is we're actually going to subtract the $9,950 that he already paid taxes on. So this is how he's only paying 12% on money past the first $10,000. The first $10,000 only gets taxed once at 10%. Now the next $30,000, that's what this would be, about $30,000. If you take $40,000 minus about $10,000, you get about $30,000. That's going to be charged at 12%. That one I'm not going to be able to do in my head, so I can use my calculator. So this time I have 0.12 times, you do need parentheses here, because you want the subtraction to happen first. So that 40,525 minus 9,950. Close that off. And so we do the subtraction, we find out how much he's earning at that level, multiply by 0.12, and we get 3,669. So there you get a decent amount, but this is $30,000 worth of money that he's being taxed on right here. That's why it's $3,669, because he had this next $30,000 in taxable income. But he actually has more than this. So we actually make it all the way up to the 22%. So we go to the next row, which is our 0.22. In this row, he does not max it out. One of the big common mistakes in the test is people say, oh, he made 50,000, he's in the third row, and then they use the 86,000. No. Don't charge him for $86,000 in income. He didn't make 86,000. You can't charge him for that kind of taxable income. His taxable income was only 54,000. So in this calculation, instead of going to the 86,000, because we don't reach that, we only made it to 54,000, we're going to use the 54,000. So 54,250. But we can't charge taxes on the first 40,000. Remember, he already paid taxes for the first 40,000 in the previous 2 rows. So in this row, we have to subtract the 40,525 from the previous row. So you guys see the pattern here? Every time when you do the next row, you look at their level, if either they max it out or their level, and then subtract the previous row. So like here, I'm 22%, I'm subtracting the 40,000. And the 12%, I'm subtracting the 9,950. That's what I'm doing there. You're always to subtract the previous row. Since the first row doesn't have a previous row, there's nothing to subtract above it. That's why we don't subtract there. So we don't subtract in the first row because there's nothing to subtract. Okay, that gives us our values. So now we can multiply 0.22 times parentheses 54,250 minus the 40,525. And that will give us our taxes for that row. You notice it's a little bit less than the previous row, but that's because he didn't max out this row. If he had done, made enough money that he had 86,000 in taxable income, he would have had more in row 3 because it's a higher tax rate. But because he didn't max that row out, he only had about 14,000 in that row, and that's why it ends up being a little bit, less than the previous row. Now his taxes he owes are all these combined. So we're going to take that 995 plus the 30,669 plus the 30,1950, and that'll tell us his taxes owed. Now he still might have a little bit less taxes because there's those tax credits and stuff we'll talk more about. But for now, if we're just trying to figure out how much he has to pay in taxes, well, according to this, he has to pay the 995 plus the 3669 plus the 3019. He ends up paying about $7,683.50 in taxes on his income. So he made, 66,000 in adjusted gross income. We took out the standard deduction before he started calculating his taxes because he's taxable on his taxes. We calculated his taxes. We said he's going to pay $7,683.50. Now, just for clarity, I want to see. Let me see if I talk about this in the next page. I don't have to talk about it twice. Yeah. Okay, we'll talk there for that one. We'll just say, okay, that's his taxes owed. In real life, he might have tax credits. He's probably already paid most of this in with his monthly deposits, so you might still get a refund. Depends on how much you paid in. But that's the tax calculation. And again, in real life, you don't usually do this by hand. You don't have to sit here and calculate the different brackets. Thankfully, nowadays we have nice computer programs where you put in all your income and you pick your deduction, and then it just takes and calculates your taxes for you. And that's what the computer program, that's what software is going to do. It's going to say, oh, you had 54,250 in taxable income, so you're going to owe 7,683 in taxes. And that's what that's what the computer does for us. Okay, let's talk about effective tax rate. So your marginal tax rate, also called your tax bracket, is the highest rate at which you charge taxes. So for Alex that we just did, his marginal tax rate would have been 22% because that's the rate he got up to. So that's the highest rate you get charged. However, since only part of your income is taxed at that rate, the actual tax percentage will be lower. So even though we said, yeah, he got charged 22%, well, I got 22% for the last $14,000. He's going to actually be somewhere between like 10 and 22% because he had a little bit of each one of those levels. So he doesn't have to pay 22% on everything. So we call that his effective tax rate. And we calculate that. You can just take the total tax we found, like in the previous one, and divide it by their income. And you can get effective tax rates for different things. You can get it for gross income, adjusted gross income, taxable income. And so when people talk about effective tax rate, you do want to clarify, is it the effective tax rate based on your gross, adjusted gross, or your taxable income? But we'll talk about that here at the end of this problem. Let's do an example. We'll kind of show that. So we're going to use marginal tax rate in the table to calculate the tax. So it takes tax calculation just like we just did. For Ringo is married filing jointly. So Ringo and their spouse are filing their taxes together. They have adjusted gross income of $350,000. We want to find their marginal tax rate, or we want to find the effective tax rate based on their adjusted gross income. So first off, they didn't tell us their taxable income. They told us their adjusted gross income. They did it to us again. Pretty normal because once you have the AGI, we know that that is $350,000. We can find their taxable income just by taking that $350,000 and subtracting their deductions. Because they are married filing jointly, we're in this one, and their deduction is $25,100. So they get to subtract $25,100 before they start doing their taxes. So here we have, 350 minus 25 would be 325. We have to subtract 100 more, so it's going to be 324,900. So this is their taxable income after they subtracted their deduction. So they had that big deduction because of the married filing jointly. It's counting for two people. They made that deduction, and now this is their taxable income. Now, because they had $324,000, they're actually going to make it all the way to row 4. They don't get all the way to 329, but they're past 172. So they're going to use those ones right here they're not going to use these ones down here. They don't have any income at 400,000 or 600,000, anything like that. So this is their taxable income to do their calculations. Now we'll notice we're using different numbers because it's a different status. Single with one set of numbers, married, filing jointly is different. But we're still going to do 10% of the first row, and because they max this out, we're going to do percent of all that. So we're going to do 0.10 times that 19,900. Because that first row, they max that out, they're paying full 10% on that full $19,000. So we end up with $1,990 for their first row. So $1,990 in taxes for that first row. Nothing to subtract because there's no previous row. Now we also maxed out the next row. So at 12%, we are going to multiply that times that 81,000. But again, we need to subtract from the 81,000 this money that's already been taxed. So the 19,900 has already been taxed. So that amount we subtract, and that'll tell us how much, and then multiply by 0.12 and get our taxes for that row. So you could just do the subtraction first. You do 81,050 minus the 19,900, and that would tell you how much money is in that second row. So there's actually 61,000 in that second row that's going to be taxed at 12%. I do need to multiply that by 12 to get the tax amount. So for the second row, they're going to have $7,338 in taxes. And when they get to row three, they've still maxed out, right? Because they made a lot of money, so they've maxed out this row as well. So for their 22% level, they're going to take their 172,000, because that's the max for that row, 750. They're going to subtract the previous row. Always subtract the previous row because we already got taxed on that money. And that's how much is going to be taxed at 22%. So again, I could subtract. I could do the subtraction first just to see how much is being taxed in this row. So 172,750 subtract 81,050. So they have $91,000 in this row. It's now going to be taxed at 22%. So 0.20 times 0.22 gives us 20,174. So we get 20,174. That's for that row. So this row is getting taxed at the $20,000. But again, this is including $90,000 worth of income. So there's more in this one row than there was in the two rows previously. Also, because it's higher level of income, we're taxing a little bit higher level. The idea is that this is all going to be mostly surplus income. They're not going to be spending very much of this $90,000 in this range between 81,000 and 72,000 on basic necessities. So they've probably been able to pay that off with the first $80,000 worth of money. Most people can meet all their basic needs with $81,000. So the rest of this is going to be kind of more, what we consider fun money. It's extra money beyond their basic needs. So that's why it's getting taxed at a higher rate. And then we're going to go even higher for the next row, because now they're at the 329,000. We're going to tax that even higher level, so 24%. So we're going to do 24%. Now, again, they didn't actually make 329,000. They only made 324,000 only. It's a lot of money, but they made that much, not 329. So in this row, we're not going to use the 329 because we didn't reach that. We only reached 324. So we're going to put 324 in here because that's the highest number they reached. You never go past their highest number because then you're charging them taxes for money they didn't earn, and you still subtract the previous row, just like we're always subtract the previous row. Now I take that 324,900 that they had for taxable income. That was their taxable income. I subtract the previous row, the 172,750, and so they have $152,000 in this row. So that's income that's going to be taxed at the 24%. So we multiply that times 0.24, and that tells us how much they're going to pay for that row. For this 150,000 in income, they're going to pay $36,000. $36,516 in that row. So their total tax, how much they owe, the tax owed, is going to be the total of these numbers. We'll add those up, and that tells us how much they owe. So we're going to end up with $1,990 plus $7,338 plus $20,174 plus $36,516. So adding that all up, they owe $66,018. And it sounds like a lot if you're not used to making, $300,000 of income. But when you have 300,000, this is only a percentage of that. You still have several $100,000 to live off of, even if the government gets 66,000 of what you made. That's the idea. So this is their tax. We want to find their marginal tax rate. Well, the marginal tax rate is actually 24%. The marginal rate is the highest rate that you hit. They don't have any money under 32%. They're not in the highest tax bracket, but they're in one of the higher tax brackets. So their marginal rate is 24%. This is not what they're actually paying. If you took 24% of all their income, it'd be higher. But this is the rate, the highest rate they hit. So the highest interest rate they're paying on, or the tax rate they're paying on any of their income is 24%. Now, for their effective rate, we're going to take their total taxes they owe, $66,018, and we're going to divide it by the income. You can get different effective rates depending on which income you use. So the more of their income you use, the lower the effective rate's going to be. So we're using adjusted gross income. It's not the lowest because if you use gross income, they'd have an even lower effective rate, but it's close to being the lowest because most people don't usually look at gross. They usually look at adjusted gross. AGI was given, so we're going to divide this by 350,000. So out of that 350,000 they had in adjusted gross income, only $66,018 went to taxes. So 66,018 divided by the 350,000 income. And so their effective tax rate is actually almost 19%. So you can see that's much lower than 24%. It's almost 5% lower, a little bit more than 5% lower. So they have 18.9%. My math, I would probably tell you what to round to. This is their effective rate. So even though they made it to the 24% level, if you look at their taxes as a whole, they're actually paying less than 20%. So tax brackets are a little misleading. So someone says, hey, I'm in the 24th% tax bracket. It doesn't mean they actually pay 24% of their income as taxes. They pay something less than that. They pay a percentage of that because of the deductions and stuff like that. And this is not even counting credits. Maybe this person could add tax credits too, depending on their situation. But yeah, the effective tax rate is very different than the marginal rate. And those are very different numbers. And so you'll see people use those numbers differently depending on what kind of goals they have and what they're talking about. If they want things to look better, they might use effective rates. If they want things to look worse, they use margin rates. It really just depends on the situation. Try to spout. Okay, I've mentioned credits. Let's talk a little bit more about those. So tax credits reduce your total tax bill after your tax calculation. So you've done your tax calculations, and then you take out the credits. So these are credits for having, there are credits for having dependent children, education expenses. There's an earned income credit supposed to help people that are on the lower income levels. And there's others as well. It's even possible to have more credits than you owe in taxes. There are sometimes where someone has enough credits, they actually end up with more credits than their taxes owed. Now, when that happens, there's two types of credits. There's refundable credits and non-refundable credits. Refundable credits are credits that if you have more credits than you actually owed in taxes, the excess, you get paid. So refundable credits, you receive the full amount even if it's beyond how much tax you owe. Non-refundable credits only go up to the amount of tax you owe. So if you have non-refundable credits, they don't go past what you owe, they just go up to what you owe. They don't go past. So refundable credits would be a little bit better because you can get paid back even if you don't, owe enough taxes to get the full refundable, you still get the money. Versus non-refundable, you only get it if you owe enough taxes. So for example, I'm calculating $1,500 in taxes. However, you received a tax credit for $2,000. If it's refundable, what happens? Well, if it's a refundable credit, then we take that $1,500 he owes minus the $2,000 that he's going to have refunded, and it's with a negative $500 in taxes. And so then the government pays him $500. That's what happens. Government pays Adam $500. That's his taxes. You'd have to be kind of a pretty special situation because there's not a lot of different refundable credits, but if they do happen, and if you're in the right situation, you could end up with the government actually paying you because you paid your taxes, because they have to pay you the refund, that tax credit. Now, non-refundable, so you take that, we'd say, well, you do 1,500, subtract the 2,000, and you still get minus 500. But because it's non-refundable, this just becomes 0 because the government won't pay you for non-refundable. Government pays 0. So those are the two options, refundable and non-refundable. Again, refundable is going to be better because you can actually get paid back if you get over. If you use up all your credits on your taxes and you have a little taxes left over, it doesn't matter if you have refundable or non-refundable. They really only matter if you end up with this situation where you have you have more credits than you have taxes. Okay, how about credits versus deductions? So tax credits directly lower your tax bill. You take your tax bill, you subtract that much, and that's how much less tax you have to pay. Deductions, however, actually affect your taxable income before you calculated taxes. And that sounds better, except because you only do a percentage of your taxable income when you're doing the tax calculations, you actually only get a percentage savings in those deductions. So deductions are actually not as good as credits in that they don't save you as much per dollar. So credits usually are going to save you more. Also, it's possible that an additional deduction won't do any good because you already picked the standard deduction, and an additional itemized deduction is not going to change that decision. So a lot of times deductions aren't going to be as great as credits. Credits are going to save you a lot more money, and sometimes standard deductions won't save you any money, depending on what they are. So for example, Dave receives a refundable tax credit of $1,500 if he receives that, how much is his tax bill lowered? Well, for the refundable, he saves $1,500 in taxes. He actually gets $1,500. Whether or not his tax bill was under $1,500, because it's refundable, he's going to get $1,500. He just gets that money, $1,500 in savings, or he gets paid that. Awesome. Now, if Dave is in the 24% tax bracket and donates $1,500 to charity, which is a deduction, donations to charity are deduction, what is the maximum amount he could get? Well, since it was deducted before the taxes were calculated, if he had more than like $1,500 of taxable income in the 24% level, the best he could do for this deduction is that he would be able to take 24% of that $1,500, and that's the most he could save. So if he was lucky and he had, not lucky, if he had $1,500 in the 24% tax range, then he would do 0.24 times 1,500, and he had $360 in savings. Not nearly as good as the 1,500 from the previous part, and this is the max. It's actually possible, that he could have 0. The min would be $0 because it's possible that he's going to do the standard deduction. Maybe he doesn't have enough itemized deductions. 360 is not a lot of deductions, or $1,500 is not compared to the $12,000 you could get for being single and having the standard deduction. So if he doesn't have enough itemized deductions, he might not be able to use this. And again, his taxes might not all be at 24%. He might just have 500 at 24%, and the rest is at like lower amounts. And so he doesn't get 24%. He might get 22%. So this is the most he could save off of it. So deductions do save you money. Can save you money. Not always, because it could be 0. But credits are much better, and you can see why credits are much better. You save $1,500, you save $1,500 versus a deduction. $1,500 saves you $360. And there's a lot of options for deductions where you can spend more money to save money. You can go give money to a charity. You can go put them in a certain kind of investment account, stuff like that. But you're only saving a percentage of that. And that's the trick there. Is it's not saving you the straight amount you put into charity or the deductible accounts. So. Okay. Now, there's actually another type of tax. This tax actually, for a lot of people, is higher than your income tax. Most people only think about income tax most of the time. But you actually pay more taxes sometimes, and not everybody. Some people they pay less, but for your Social Security and Medicare taxes. So on top of income tax, the federal government collects Social Security and Medicare. We do this under the name of the Federal Insurance Contribution Act. So that's why a lot of people call these FICA taxes. So FICA is calculated on all your wages, tips, and self-employment income, but we don't subtract any adjustments or deductions, and it does not apply to interest, dividends, or profits from sales of stock. So if you're investing in stocks and bonds and that kind of stuff, you don't pay FICA tax on that. This is more for like the labor wages you have. So if you're working a job and you're making wages and tips, that's where your FICA tax is coming. This is supposed to say 2021. I'm just going to cross it out. So these are the FICA. When I looked this up, I think the book had from 2021, so I just used that from the book. So you had to pay 7.65% on the first $142,800 of income from wages with employer matching. So if you earn money up to $142,000, 7.65% of that is going to come out of your check and get sent to the government for FICA taxes. And then your employer actually has to match that. So they actually have to pay 7.65. It doesn't count out of your income, but they match it. So say you end up paying 2,000 FICA taxes out of your income. The employer takes 2,000 and they send that also to the bank. So they pull 2,000 out of your check and they put 2,000 of their, profit revenue, and that all goes in there. So the government actually gets 4,000, 2,000 from you, 2,000 from the employer. If you make in excess of 142,000, then anything above 442,000 is taxed at 1.45%. Now it might feel kind of weird that before we do an income tax, we talked about the progressive and how it got higher. Here it's getting lower. But the idea is that with FICA and Social Security, it's usually for people who are not making enough money to pay their bills, so they need some help, especially when they get older in retirement and stuff like that. And people that are making over $142,000 a year usually have plenty of money to put into a retirement and savings account, investments accounts, and they don't need that money to support them, towards the end of life. Is typically the idea. They've already paid 7.65% on the first $142,000. So they have that to live off of. If nothing else, that should cover their basic necessities. So the 1.45% it helps increase the amount that's in Social Security, so they can get there's more to go around. But it's less about supporting that person when they go to retire and they might not have enough than it is about funding Social Security. Self-employed individuals actually have to pay both the employer and employee shares of FICA. So it's actually a lot of people have the double tax because you have to pay twice as much. Now it's not actually twice. There's actually a little tax deduction you get if you're self-employed and you're paying your FICA taxes. So you do get to save a little bit of money on that, but effectively you have to kind of pay it first and then get a deduction on your income taxes. So self-employed people end up paying both halves of that versus the employer pays half and the employee pays half when it's an employee-employer relationship. There is an additional Medicare tax, so this doesn't apply to Social Security, but for Medicare, it's 3.8% on income not otherwise subject to FICA taxes. So things like investments and dividends. So normally you don't tax that for FICA, but now, and this is something actually recently, I think since 2017 was added in. But now if you have interest income, dividend income, that gets a 3.8% charge for Medicare, and there's a 0.9% surcharge on ordinary income, such as wages, tips, and interest for Medicare. So that's new kind of charges to add to Medicare to fund Medicare. Okay, let's look at the example, kind of figure out FICA. We're going to do FICA and income. We'll do the whole shebang on this one. So a man earns $36,200 in wages and tips. He had no other income and made no contributions to retirement plans. He is single and takes the standard deduction, calculate his FICA taxes and income taxes to obtain a total tax bill. Then find the overall tax rate on the gross income, including both FICA and income. So we're going to do everything. This is going to take a minute, but we'll get it all done. So first off, he has wages and tips. He has no other income, no contributions to retirement plans. So this is his gross, but it's also his AGI because he had no adjustments. So we have AGI. AGI is $36,200. to get taxable, we take that AGI and we subtract his standard deduction. I think I said he is single, so he gets a standard deduction of $12,550. That's the standard deduction from his amount he has. So he would be at $20,400, which would be $20,300. Oh, I should just do it on calculator. I can do it in my head, but I'm gonna make a mistake so I'm just gonna do it this way. That's what calculators are for, right? 12,550. So it's $20,450 of taxable income. So it's taxable income. Go back to our tax charts that we've been using. Because he's single, his taxable income, he makes it up into just the 12% branch. So we're going to do 10% of the first row and then 12% of the second row minus the first row. So to get his income tax, we're going to have 10% times that $99.50, which ends up being $995 in tax, and 12%, but this one he maxes out at $23,450 minus the previous row, $9,950. That'll give us the second row, the margin, the second bracket, how much he pays for tax for that bracket. So we're going to do $23,450 minus the $9,950. So the subtraction is about $13,000 in this row times the 12%. I end up with $1,620. So the total tax for income, income tax, is $995 plus $1,620, $2,615. That's his income tax. Now I got to do his FICA tax. So FICA tax, if he had any investment like interest or dividend income, we wouldn't include that. We don't have to worry about that because all he has is wages and tips. So to do his FICA tax, we just look at the fact that he has made less than $142,000, so all his money is going to be charged at that 7.65%. For this one, notice this is high income taxpayers. He's not a high income because he's only in the second bracket, so he's not going to be paying the 0.9% surcharge on ordinary income. So all we have to worry about is just the 7.65%. We only hit this if we got high enough for the high income levels. So for his FICA, he's just going to do 0.0765, and this is towards all his money. Again, we don't do adjustments or deductions, so we actually multiply this times his 36,200. We don't use his taxable because with FICA you take it out of your adjusted gross, or actually your gross. In this case, the adjusted gross is the same as gross. That's why we take it out of that. So that's how much he's going to be paying, taxes on. So 0.0765 for his FICA taxes, 36,200. He ends up with $27.69.30. So that's FICA taxes. So his total tax, total, like all the tax he's paying, is going to be that income tax, $26.15, plus FICA tax. And notice the FICA tax is actually higher. He's actually paying more in FICA taxes than he is in income tax, and that's not unusual for a lower income person. 69.30. So he has $5,384.30 in total tax. That is all the taxes he's paying for the year. Now, to get his effective tax rate, calculate his FICA taxes, define overall tax rate. To get his tax rate, we're going to take this and divide it by his gross, or AGI, because they're the same in this case. And we're going to divide that, and we'll find his tax rate. What percentage of his money is being taxed? So divide that by 36,200, and that'll give us his tax rate. So 5384.30 divided by 36,200. He ends up with actually being about almost 15%. So 14.9 or 15%. That's his basically effective tax rate for his total taxes. So including FICA and his income tax total, he's paying about 50%. Yeah, he was only at 12% for income, but we're adding the FICA taxes in as well, so that's why this is a little bit higher. So in real life, your effective rate, if you include all the taxes you pay FICA as well as income tax, it's actually higher than just the income tax rate is. Okay, last thing to talk about, we're not going to do any more problems, but just mention real quick. There are taxes, income taxes on dividends and capital gains. So income from dividends, on stocks, capital gains when you sell stocks at a higher prior than you paid for them, you get special tax treatment. If you buy and sell them short term, so if you sell them within 12 months, then they actually get taxed like ordinary income. So this is when people sit there and they, day traders, that kind of thing, where they're sitting there buying and selling stocks all the time. Those people are considered, basically to be doing a job. They're trying to make money by watching the market and buying and selling on a day-to-day term. And so they're charged like income tax. The money they make by doing that charge is just regular income. If you buy and hold a stock for over 12 months, it's considered long-term and has a special way of being taxed. Again, these are not 2013, this is 2021. I have lots of typos today. Sorry, I had these notes ready, but I made a lot of mistakes. All right. So for this one, it's 0% for income less than 40,000. So if you're making less than 40,000 on your income, and you have these long-term investments with capital gains, then you don't have to pay any taxes on those. And that's for single, of course, 80,000 for married filing, which is double. You have to pay 50% if you have income above 441,000. So basically, you can make up to 441,000. So between 40,000 and 441,000, then you pay 15%. And then income past 441,000 only gets charged at the 20% rate. And again, that's single, and the married is more. So the idea is that this income isn't charged taxes on unless you're in the higher brackets. If you're making tons of money already, then your income from selling stocks and stuff at this level is going to be taxed. But if you're in the lower levels, then it's going to be not taxed or taxed at a lower rate. That's how dividends and capital gains work for now. And then tax-deferred income, again, we mentioned this. The U.S. government tries to encourage long-term retirement savings by allowing you to defer income taxes by contributing to special retirement plans like SEPs, 401ks, IRAs. So the chart shows how if you use pre-tax and post-tax money, you can save a lot with the pre-tax. So your taxable, right here is the blue. You can see how it's a lot shorter. And the tax deferred is actually the black. It's supposed to be red, but it looks black. That one is a lot higher. So that's where they're investing with pre-tax money. So they actually get to use more of their money. If they had to take out the taxes first and then invest it, they'd get a little bit less to invest. And so it grows a lot better. So when you go to retire, if you use the pre-tax investment, you have a bigger chunk of money to invest with, in retirement, and you're a lot better, more ready for retirement. So that's the idea. The idea is that using pre-tax money, you can have more for retirement. Okay, hopefully that helped you get a better idea of how taxes work. I know this one went a little bit long. Sorry for that. I am done with Unit 1. We're done with personal finance. So next time I see you, we'll be going into our next unit. Take care.